afternoon. It's the first month of the year, and already we are seeing improvement on the performance of the NSE. There has been a rise on the NSE All-Share Index and the market's capitalization. Joining us today to help us discuss the general performance of the NSE with a particular interest on the equities market is Mr. Nderi, the Manager Corporate Finance of ABC Capital and the former Head of Research at Suntra Investment Bank. Thank you so much and welcome to the show.
Thank you for having me.
Firstly, there has been an uptrend at the NSE. What do you think is the reason for this?
Well, a number of factors. Like you rightly said, we're coming off a good year, so the professional investors are back at it. The first quarter of the year is usually characterized by earnings season, and so we are waiting to see what companies will announce, and therefore a lot of investors are taking positions after their exits, thanks to the end of the political season. Now they are coming back and they're taking positions with a view of trying to take advantage of opportunities that exist ahead of earnings season.
The Kenyan shilling has strengthened against the US dollar recently. So do you find any inverse relationship between the performance of the NSE and the treasury bills, bonds, and the Kenyan shilling?
Yes, largely. Obviously, the primary determinant, in my view, of the exchange rate has always been the central bank, and monetary policy directly impacts the exchange rate, but also impacts the bond market and the equities market. So, for example, if they were tightening, if CBK were tightening, you'd see it in either higher interest rates, lower asset prices, and I think to a certain extent that's what we're seeing. That's what you're saying, and especially given the loose fiscal policy that the current government is running. So you've got all those contradictory forces. But one of the, I think, positive things we're seeing out of that all this is low inflation, and let's not also forget the impact of the interest rate cut, which is actually one of the causes of the tight monetary policy, which is leading to directly strong Kenya shilling.
The year 2017 had so much political activities and had major dent on the economy. Generally, what would you say investors should expect in the year 2018?
Well, 2018 is going to be a very interesting year. We are hoping to see recoveries. Looking at the market PMI purchase manager indices or index published by Stanbic, we're seeing a strong recovery in private sector activity, which means that it was being held back by political uncertainty, and therefore that's one area of recovery we are hoping to see. The other area we are looking to see some recovery is foreign investor participation in Kenya, at least at FDI level. So we are hoping to see how that will affect the economy and the markets in particular. The other area, of course, is government activity. So if that returns to normal, then suppliers are paid. Again, we will see some normalcy in that area. But other challenges still exist. Like I mentioned earlier, the fiscal policy, we believe it's a bit loose, too loose at this point. I did mention the constraints on monetary policy as a result of interest rate cap. We don't know if that will be remedied this year. But even that notwithstanding, we expect to see recoveries in some stocks. Some stocks like Safaricom were never really affected, but banks, we think that some of them are trading at a discount that investors could take advantage of, and in the areas of energy, we expect growth as a result of investments that have been done in the prior years and ongoing investments.
Moving on to the banking sector, do you think that there will be any impact of the new reporting standards, and will banks blame it like Britain did when they announced a profit warning?
I think the market has overreacted to that particular bit of news. As you've seen, if I look at the prices of banking stocks relative to their NAVs, I think they'll be largely all right. Now, to come to IFRS 9, there are two effects it will have. Number one, it will have a constraining effect on lending because of the impact on how provisioning is done, and because it dictates how provisioning will be done, and that has an impact on both the balance sheet and the income statement. So it will, for regulatory purposes, which has been since been clarified by CBK, that they will not use that for regulatory purposes. If they had, it will have an impact on regulatory capital, and then banks will have had to, either raise more capital or curtail lending altogether. But since that clarification from central bank, I think the only thing is about reporting now. Now, from a real perspective, and because of the interest rate cap, in any case, banks had focused their loan portfolios largely to government securities. In as much as there's been an impact, but I think it will have been more of a paper impact than the actual profitability impact. Because as loans are being paid back, and as interest rate is being, as the portfolio is being written back in terms of projected losses that have not occurred, I think there will be some sort of overperformance. So in the short run, there might be some impact on share pricing, I think, but I think we'll also know more when the banks release their full years.
So let's talk about Kenya Airways. What do you make of the company's future now that it's just converted its debt to equity and just got a license to fly directly to the US?
Well, yes. First, because of the restructuring of the balance sheet, that has given them the room to pursue their strategy clearer now. With regards to working capital, the restructuring also secured them more funding from the local banks that will allow them to, restructure. Fund their businesses going forward. Now, I think the stakeholders of KQ as well have seen what KQ has gone through. Maybe we'll see a little bit more softer unions, because one of the biggest costs for KQ has been staff costs. One area of worry perhaps is energy prices. If you remember when oil had hit $110, $20 per barrel, it was a problem for the global airline industry. And that's when the first time that KQ got into the hedging business. So we are seeing a rally of oil prices, and we hope that those ones will be contained, or they find some way of managing them. The other headwind that KQ might face, other than energy and stuff, is competition. as the world becomes more developed and countries become looser with regulation with regard to how cities connect through the through airlines or airline arrangements, a lot more competition is going to be. I mean, KQ is going to face a lot more competition, so they have to manage that as well. So those are the things, the three key concerns for me. And of course, if they're not able to manage that, they'll be back to where they started. But I think they are now on a sounder footing, and they've been given a second chance to implement a strategy better now.
Without KLM being one of the largest shareholders in KQ, do you think that KQ has a better chance to increase its profits?
Well, the KLM Air France arrangement was not governed, in my view, as a result of the shareholding, but more of an agreement that KLM Air France got into with KQ. In my view, I don't think, if you look at it from the revenue splits, I think it was too small a market to warrant the losses that KQ was making. So in my opinion, I don't think it should be an excuse. I think they should have been able to compensate from other because that largely governed the Africa-Europe routes. So now with Africa-Asia routes, should have compensated, or rather should not. So I think it was a company-wide problem. I don't think it was the problem was as a result of KLM relationship with KQ.
So what's your thoughts on anyone who would want to put their money in the NSE?
So anybody who wants to invest in the NSE, there are a number of things to consider. From a product development point of view, it looks fantastic because they've launched the ETFs, the gold ETF, which obviously will serve as sort of a template of other ETFs. There's the REITs, again, same argument for that from that perspective as well. They are looking to do derivatives. So from a product development perspective, they look all right. But one must remember that with every new product, there's an investment in systems, and those systems are not cheap. So when we look at the market, we find that it is still bonds and shares that drive the biggest revenues. I don't know if it's an issue with building up capacity within brokerage, or is just that the market was not prepared for some of these products because their uptake, especially for the gold ETF, has not been very strong. So I think there needs to be also, from a NSE perspective, as a shareholder, one would hope that the market's needs are matched with company investments, so that there's further uptake. There's a faster uptake in NSE products. However, bit about investment is about the future, not now. So that sort of guarantees future revenues in a sense. But in the near term, we're still looking at equities and debt. I think for me the most interesting development is the just like what we saw with the bonds, where you have trading that can be done. You can do up to 3 trades in a day. That boosts day trading, and we expect to see the same in the equities if that happens, and that can attract a lot more money to the stock market with T+1 or T+0 trading regime.
We have taken like 3 years to introduce.
Don't you think they'll take a longer time to introduce short selling like they've done with other products?
Short selling is a very interesting products that they've put in the market. But it will be very, in my view, it's a bit restricted in the way they've drawn up the laws or the rules and regulations governing the product. So I expect it will take a bit of time for people to appreciate it and implement it. But I think it becomes even more useful when you have the day trading, either T+1 or T+0 trading regime. And that way, I think the risk can be managed or can be accepted better by short sellers.
Uchumi supermarkets. For a short-term trader, it will be an opportunity to buy given the stock is down by 20%, and they announced plans to close 2 of its branches to a profitable location. What's your take?
So Uchumi is a very interesting stock. I think it enjoys a lot of goodwill from the market. We've seen this. I think Uchumi died once, was resuscitated. Now it's in ICU. For me, the most important development for Uchumi is the hiring of the CEO, Andrew Dixon. Very knowledgeable in the business. And the retail business is a very tough business. It's about managing working capital. It's about managing relationships with suppliers and getting customers through your door, getting to good locations that with high footfall. Now, for Uchumi, part of the problem was working capital management or mismanagement, if I may put it that way, and of course shrinkage from their staff fidelity. So I am hopeful that in the long run, Uchumi will revive and become a fully functional company. But we must also take into account that the competition they face from other companies existing. The Tuskys, for example, Naivas is growing, Carrefour is strengthening. Other young players like Eastmart are coming up, clean shelf. So it will not be an easy ride, but nevertheless, I think they still hold all the ingredients for a successful company. And I think the primary concern for me will be the quality of the talent that they have at board and senior management level. So the acquittal, if I can call it that, by the courts of some of the directors of Uchumi raises a number of issues. The number one, of course, is why did Uchumi get the problems that it did? But more importantly, what is the role of CMA? Did they accurately diagnose the problems within CMA? Within Uchumi, and was the response appropriate to the issues are concerned? But one thing we have to remember as investors, every time make an investment in a company, is you are taking a risk position, and you might not necessarily know exactly what's going on in the company. So due diligence is important. Also, an understanding of the management capabilities is important, and strategy as well. Now that will just make you alive to the risks, but it will not completely mitigate all risk in investment. But at the end of the day, buying a stock is buying risk, with the hope that there'll be a reward within a certain time period, which you call your investment horizon. So, in my opinion, all business is risk, and there are many number of risks. Anybody who has participated in any corporate finance transaction will be able to tell you the risks are many. But the question is, how are they mitigated, And one way of mitigating some of these risks is through diversification of portfolios, and that's how we do it. So, in my opinion, risk will always be there in the market. It's just a matter of how you manage your risks, and hopefully that will lead you to very good returns going forward.
The biggest listed company, Safaricom, recently reached a new high of 30 shillings. Don't you think it raises questions about its fair price?
So Safaricom is a very interesting stock. When you look at the historical performances, it's really performed. Partly is because of its very high return on equity, or return on investment, if you will. Safaricom has a very good culture also of being continually developing new products. Not all of them pan out. I remember, if you remember, there was Safaricom Live at some point, and other similar products which didn't quite blossom. But then you've had other products that have gone on to exceed our expectations. M-Pesa being one of them, and it looks like data will be taking up the baton going forward. And we expect Safaricom to continue with the innovation going forward. They're right now investing in fixed data. I think the feeling within Safaricom is that mobile data has a ceiling, but fixed data is the new growth frontier. As a communication company, they want to own that space. They'll be competing with the likes of Wananchi and Fiber, Access Kenya on those fronts. Now, with regards to valuations, how do we see Safaricom going forward? For me, Safaricom is a counter that's heavily dominated by foreigners. So what does that mean? It means that the required rate of return for foreigners, given the very stable shilling dollar exchange rate, suggests that the required rate of return for foreigners in Safaricom is much lower than for Kenyans, and that's why it's very difficult for some analysts to accept the valuation of Safaricom, because the discount rate here is many multiples of the discount rate of foreigners, and as a result, the valuation of Safaricom seems a bit high relative to what the discount rate for Kenyans is. So from my point of view, I think any risk of price volatility from Safaricom will arise from changes in monetary policy, for example, by the Fed or the Bank of England or the ECB for that matter, because I think Safaricom is more dependent on external monetary policy than local monetary policy with regard to pricing.
Thank you so much, and we will always keep you updated on the market. That was Nderi, the Manager Corporate Finance at ABC Capital, giving his opinions on the market. Remember, you can always find us on Twitter at @prime_equities. I've been your host, Faith Mokam.